Good afternoon, everyone. Welcome to our webinar. I would like to introduce myself. My name is Alina Kulikovska. I'm team leader of legal department of corporate service department. So today we will discuss, we will revise Singapore tax system. Some general overview of Singapore tax system. I would like to put your attention on chat box on the left side of your screen. So here you may write your questions, comments, some clarifications, anything. So please be active. Before starting our webinar, I would kindly ask you to let me know that you hear me well. Thank you. So let's start our webinar. First of all, I would like to start with some overview, some description of Cyprus and Singaporean tax systems. So you may find on this slide the main points of those both tax system, tax jurisdictions. So principle of taxation in Cyprus, all income received all over the world is taxable. If to speak about Singapore, it's territorial principle. Corporate tax rate in Cyprus is 20.5%, and in Singapore it's almost 17%. Tax allowances in Cyprus, there are less tax allowances, but they are much enough in Singapore. If to speak about VAT, GST, in Cyprus it's 19% and in Singapore it's 7%. Why I mentioned GST? Because it's the same as VAT, but in Singapore. We'll discuss it later. Outcome dividends in Cyprus, they're paid only by tax residents of Cyprus, and in Singapore, outcome dividends, they are not taxable. If to speak about income dividends, so in Cyprus, non-taxable if it's non-investment company with income of more than 50% received from investment activity of the company. So in Singapore, non-taxable if corporate tax in other country not less than 50%. All these points we'll discuss more next. We'll discuss more details, but it's some kind of general overview, some comparative table to understand for you the differences between Cyprus and Singapore. Going on. So, withholding tax in Cyprus, so occasional royalty in Cyprus, etc., and in Singapore used very often. Capital gain tax, 0 in Cyprus and 0 in Singapore, but in Cyprus, capital gain tax is on property. If to speak about tax year, in Cyprus it's calendar, in Singapore it's financial. And provisional payment of taxes in Cyprus it's up to 1st of August, and in Singapore it's 3 months after financial year end. So if the financial year end of the company is the 31st of December, then the provisional payment of tax should be submitted till the end of March each year. Submission of tax return in Cyprus is during 12 months till the 31st of December, and in Singapore it's till 30th of November, stable date. These double tax agreements in Cyprus, the amount approximately of 70 signed agreements. In Singapore, it's approximately 50 signed agreements. Income tax for physical persons in Cyprus is progressive till 35%, and in Singapore, it's very low rate for non-resident. So I think that we need to start to discuss the Singaporean tax system. And first of all, let's talk about the principle of tax system in Singapore. Is the tax system in Singapore based on territorial principle? The principle, the taxable is only income received on the territory of Singapore or deemed to be received in Singapore. All this is prescribed by Income Tax Act on Section 10. So you may find information about Income Tax Act, about everything on Section 10. I found information that someone is not here. Someone hasn't hear me well. Tell me, please, who else has a problem with hearing me? Okay, let's continue. So, taxable principle, territorial principle of taxation in Singapore, that mean that if you have a bank account, for instance, opened in Singapore, so you will pay all taxes in Singapore. But if you have, in other cases, if you have a bank account out of Singapore and you provide services or trade out of Singapore and receive income on or your bank account opened out of Singapore, then you will have no obligation for taxation. But still need to understand that there can be deemed income. So we will discuss more in details about income received or deemed to be received. What does it mean? Singapore is a good tax jurisdiction because there you may just you may find the solution where to pay tax, in which amount. You may have two bank accounts and work with them together, and then taxable will be only those income received on the territory of Singapore. If to speak about those income which deemed to be received in Singapore, that means that any amount received out of Singapore but transferred on bank account opened in Singapore, that means that those amount will be taxable in Singapore. Any amount received out of Singapore but directed to payment of suppliers' invoices in Singapore, those amount will also be taxable in Singapore. Any amount received out of Singapore but directed to a purchase of property, it also be deemed as income received on Singapore. I think it's better to discuss tax principle on some samples. So the first one is following. Singaporean company has bank deposit in HSBC Bank. Account opened in HSBC Bank opened in Hong Kong. So the interest from such deposit in Hong Kong are not taxable in Singapore because they're out of the territory of Singapore. But if we will revise the second sample, we will find that the others, the deemed amount to be recognized as income received in Singapore. Singaporean company use the bank account in Bank of Cyprus for trading. First of all, we can think that it's out of Singapore. But the supplier from Germany supplies the equipment to Singapore, to the territory of Singapore, and all payments of suppliers' invoices provided from Bank of Cyprus. So from from bank account opened in Bank of Cyprus, those invoices with payment to suppliers are recognized as taxable in Singapore. Income deemed to be received in Singapore. Now I think it's better to discuss tax exemption of foreign income. So revenue received out of the territory of Singapore should be recognized as foreign income. That means what does it mean foreign income? It's dividends, it's revenue of representative offices, revenue from export of services or service providing in Singapore, out of Singapore. They will be exempt from foreign income. 100% tax deduction of the foreign income applied in following cases. If the corporate income tax is in those foreign country, is more than 50%. It's one of the main principles, one of the main rules in Singapore. If the corporate income tax in other country is more than 50%, then no taxes will be paid for foreign income in Singapore. The second point is that if the tax was paid in other country, avoidance of double taxation. So here we may use and may apply for the double taxation agreement, of course, if it's signed between countries. And the third point, if the Singaporean Tax Authority, IRAS, provides deductions for such income. So moving on, and right now I would like to discuss why Singapore also so attractive tax jurisdiction for newly incorporated companies, for startups. So it's because of tax exemptions, which are provided for companies newly incorporated that fulfill the certain conditions. About conditions we'll speak later. So the full tax exemption provides to the companies for the first 100,000 Singaporean dollars in the amount of 100%. So first 100,000 are non-taxable. The next 200,000 of Singapore dollars they are deductible in the amount of 50%. So there we can find 300,000 of Singaporean dollars. On the first 300,000 of Singaporean dollars, we have tax exemptions. So for all startup companies, it's a good opportunity. It's attractive jurisdiction because there is a tax exemption even in 100%. We mentioned about certain conditions for tax exemption for new incorporated companies. So the main conditions for newly incorporated companies are tax residence in Singapore. Number of shareholders in such company should be less than 20. Shareholders should be physical person, or at least one shareholder is a physical person holder of 10% of share capital of such company. But in other cases, if your company is not received all these main conditions, you may also use partial tax exemption. Other newly incorporated companies has tax deductions in the amount of 35 and 50% for for the first 300,000 Singaporean dollars as well. So first in 10,000 has tax deductions in the amount 75%, and the other next 290 thousands will have tax deductions in the amount of 50%. The main rule of management and control the main rule of management and control in Cyprus, and if you want to have some tax deductions, it's better when you are tax resident of Singapore. When you earn foreign income from a treaty country, you may be subject to tax in that foreign country. However, you may wish to claim the double tax agreement benefits that entitle a Singapore tax resident to enjoy a reduced tax rate or a tax exemption in that foreign country. To enjoy this benefit, you need to submit the certificate of residency to the foreign tax authority to prove that you are a Singapore tax resident. The avoidance of double taxation agreement is an agreement signed between Singapore and another country that serves to relieve double taxation of income earned in one country by a resident of the other country. Only the tax residents of Singapore and the respective treaty country can enjoy the benefits of a double tax agreement. So, if to speak about companies, so a company is a tax resident in Singapore when the control and management of the company is exercised in Singapore. It's prescribed by Section 2 of Income Tax Act. Those fact that company incorporated in Singapore is not crucial, and it's not mean that company will be automatically recognized as a tax resident of Singapore. Control and management is the making of decisions on strategic matters such as those on company policy and strategy, where the control and management of a company is exercised is a question of fact. Typically, the location of the company's board of directors meeting, during which strategic decisions are made, is a key factor in determining that where the control and management is exercised. For receiving the tax certificate of residence in Singapore, you need to apply for it. For this, you need to complete the application for certificate of residence and submit to IRS. You may submit it by email, post, or by fax. This certificate of residence is a letter certifying that you are a tax resident of Singapore for the purposes of claiming benefits under the double taxation agreement. Please find that today we'll discuss mostly not individual but corporate taxation, corporate tax in Singapore. Administration of tax system in Singapore. First of all, there are some points of administration of tax system. It's a submission of ECI form, tax calculations on the basis of submitted ECI form, dispute resolutions, payment of tax liabilities and penalties and fines. We'll discuss each point more details. So, first of all, we need to start with estimated chargeable income (ECI) with their calculation, and first of all with the submission of ECI form. ECI form, estimated chargeable income, should be submitted. Must be filled within 3 months of the company's year end. It's prescribed by Income Tax Act. Tax may be paid partially in the case the ECI form was submitted during the first, the second, or the third month. In other cases, there are no exceptions. Only after confirmation by the IRS, the submitted ECI form, they proceed with calculation of estimated chargeable income. So, for the calculation of estimated chargeable income, to reduce the compliance costs of businesses, IRS will improve the tax filing process for companies by revising the criteria for ECI waiver as follows. Company's financial year ends criteria for ECI waiver in or before June 2017. Annual revenue is not more than 1 million for the financial year, and ECI is nil for the year end. In or after July 2017, annual revenue, the criteria for ECI waiver is annual revenue is not more than 5 million for the financial year, and in this case, ECI is nil for the year end. Companies that meet the criteria do not need to file their ECI for that particular year end. There is no need to inform IRS about this, and if they do not meet any of the criteria, they will need to file their ECI for that particular year end. So here we just have information, received information about those criteria when ECI form can be omitted, and there are no necessity for submission of this form. There are two main criteria. After the calculation of tax, every company submitted ECI form can receive the tax assessment from IRS. The tax must be paid within 1 month from the date of the notice of assessment, unless you are paying via some system. The notice of assessment will include information on the various ways to pay. There are two ways to pay your taxes: payment by giro. Companies that wish to pay tax by installment must sign up for giro by submitting a giro application, or payment by other electronic modes. You can also make payments via internet banking, phone banking, NIS, and so on. But let's discuss what does it mean, a notice of assessment. Notice of assessment refers to your tax bill. It shows that the types of income and amount of income subject to tax calculates as the tax amount you need to pay, the deductions, for instance, relief, expenses, donations, given, as well as a credit balance to be refunded to you. Additional notice of assessment you will receive when the final tax amount is bigger than estimated tax. The amended notice of assessment will be received when the final tax amount is less than estimated tax. And final notice of assessment, which can be received, is when the company is in the process of winding up. So in Singapore, there are 4 assessments from tax authority, from IRAS. It's notice for assessment. We were notified the amount of payment. Then additional notice, amended notice, and final notice of assessment when the company is almost closed. If you are not agreed with notice of assessment, of course you can just file with appeal, notice of appeal. So companies must file their objections within 2 months for the date of the notice of assessment received. If no objections are received within that period, the assessments will be treated as final. For example, if you receive a notice of assessment dated the 5th of January 2017 and do not agree with the assessment, you have up to 1st March 2017 to file a notice of objection to IRAS, some kind of notice of appeal. All taxes should be paid. It's known, but Singapore is most strict jurisdiction for this, and there are a lot of penalties and fines. We'll discuss it later. So all taxes should be paid within 1 month after receipt of the relevant notice of assessment. In case of disagreement with a notice of assessment, as was discussed before, the taxpayer is still obliged to pay taxes and only then to appeal. And we revised that there are 2 months for appeal. In case of non-payment, a fine of amount of 5% of the tax amount is imposed. If payment is not made within 60 days, then 1% penalty is added for each subsequent month. So additional penalties may not exceed 12% for each month. The total amount of interest should not exceed 17%. That means that 5% fine and 12% for additional penalties. Which penalties and fines? The fines are also in Singapore legislation. So for failure to comply with the requirements of the tax legislation, and if the tax return was not submitted within 2 years, then in accordance with Section 1494 of Income Tax Act, there can be fine for 200% of the amount of tax, or the penalty in 1,000 Singaporean dollars, or in the case of non-payment of tax, imprisonment for up to 6 months. Please find that only director is responsible for those penalties. So for those penalties and fines. So that's why if you are using a nominee service of Eltoma Corporate Services, you should be aware that if there are any penalties, either not submission of any form, ECI form or C form, tax return, something like that, we will have penalties. Your company will have penalty, and only the director is responsible for all activity, for submission or non-submission, for payment or non-payment of taxes and other forms of the company. That's why we're signing a lot of documents with our nominees and with our nominees and our clients. Also, we ask our clients to provide us with a director deposit only in those cases when we receive some penalties or fines. Providing a wrongly submitted declaration or incorrect data will be punished in amount of 100 fine on the amount of unpaid taxes. Submission of incorrectly filed in declaration or incorrect data without providing explanations or negligence it's a fine or in amount of 200% of the amount of underpaid tax. The maximum penalty is 5,000 Singaporean dollars and imprisonment of intentional evasion from payment of taxes or cooperation to other persons in situation is penalized as a fine of 300% of the amount of unpaid tax, a fine of up to 10,000 Singaporean dollars, and imprisonment for up to 3 years. Fraudulent tax evasion in especially big amount should be penalized as a fine of 400% of the amount of unpaid tax, a fine of up to 50,000 Singaporean dollars, and imprisonment for up to 5 years. Advanced tax rulings. It was coming into force on January the 1st, 2006, governed by Income Tax Act as well. The application for advanced tax ruling must be submitted within 2 months with payment of 535 Singaporean dollars. The application for advanced tax ruling must contain detailed transaction description, proposal for the application of tax for this transaction, description of the business of partners involved in the transaction, what is the reason for the need to use special conditions for the application of tax, the hourly payment for the consideration of the application, and there is a possibility for acceleration of receiving from receiving the advanced tax ruling at a double rate. So that means that if you not certain in some payment of taxes in some transaction, how it will be is it taxable or non-taxable, you can advise for advanced tax ruling. Now I would like to discuss with you taxation of dividends, interest, and so on, withholding tax. And we will start with dividends. Dividends are paid out of profit after the payment of all other taxes. The decrease in the authorized capital and distribution of capital after the company's liquidation is not a distribution of dividends. Outgoing dividends are not taxable in Singapore, one tax system. Dividends accrue in the year that they are declared payable. You do not need to declare taxable dividends in your tax form if the organization indicates on the dividend voucher that they will provide the dividend information to IRS. Otherwise, you need to declare all taxable dividends in your income tax return under other income. Which dividends are taxable and which dividends are non-taxable? Generally, the following dividends are non-taxable. It's dividends paid on or after the 1st January 2008 by a Singapore resident company under the one-tier corporate tax system, exempt cooperatives. Foreign dividends received in Singapore on or after the 1st of January 2004 by resident individuals. If an individual resident in Singapore receives foreign sources dividends through a partnership in Singapore, these dividends may be exempt from Singapore tax if certain conditions are met. Income distribution from real estate investment trust, exempt distributions derived by individuals through a partnership in Singapore or from the carrying on of a trade, business, or profession in such trusts. If to speak about those dividends which are subject to income tax, so they are following: dividends paid by cooperatives, foreign source dividends derived by individuals through a partnership in Singapore, income distribution from real estate investment trust derived by individuals through a partnership in Singapore or from the carrying on of a trade, business, of profession in those trusts. Interest received from deposit with approved banks or licensed finance companies in Singapore is non-taxable. Please notice this. Moving on, and let's discuss in taxation of interest. So interest is the payment for the use of credit funds. Taxation of interest is subject to the territorial principle of taxation. Accrued interest is taxable. If interest earned outside of Singapore, so foreign earned interest, and not listed in Singapore, it's not taxable. Income from interest listed in Singapore is not taxed if in other country, the corporate tax rate is not less than 15%, and not taxed due to tax credits received. Interest received from deposit with approved banks or licensed financial companies in Singapore is non-taxable. Interest received from the following sources taxable when it's deposits with non-approved banks, deposits with finance companies non-licensed in Singapore, loans to companies, persons, etc., interest from refund of excess employees CPF contributions, the securities that are derived from a partnership in Singapore or from the carrying on of a trade in debt securities. You need to declare the full amount of your taxable interest under other income if your tax in your tax form. Moving on. It's better to revise everything and understand everything on samples. So here you may find one sample, first sample for taxation of interest, where we discussed it more in details. So in our sample, the company in Singapore gave a loan to the Hong Kong company. The company in Hong Kong only conducts offshore activities, provides only offshore activities, and doesn't pay any taxes in Hong Kong. So it's non-taxable in Hong Kong on territorial principle of taxation. Similar to Singapore, but still very different. Interest income is not taxable in Singapore because the corporate tax rate in Hong Kong anyway, it's offshore or offshore company in Hong Kong. But the corporate tax rate in Hong Kong is 16.5%. So it's more than 50%, and we can use our rule for when the corporate tax rate should be not less than 15%. So in this case, the interest won't be taxable on the territory of Singapore. In other sample, we have a Cyprus holding company, which has a subsidiary in Singapore and gave a credit to this subsidiary. The interest earned by a Cyprus holding company will be taxable in Singapore if all conditions of the territorial principle of taxation are not met. That means that in Cyprus, the corporate tax rate is 12.5%. And in Singapore, it's the main rule is not less than 50%, 15%. So the interest will be taxable on the territory of Cyprus. But the situation is changing if the Singaporean company used a loan to purchase a real estate in Dubai. In this case, the interest income of a Cypriot company won't be taxable in Singapore. Tax losses. The losses of the Singaporean company, which are recognized as taxable, can be offset against future profits for an unlimited time if there is no change of shareholder in the company. Tax losses can be used to reduce the profit of the previous period. Also, tax losses of one company in the group can be transferred to another company in those group. But there are some main conditions for such transfer. So the offset of intragroup losses started to be recognized from the January 2003, and that off can take place if the following conditions are met, such as when both companies belong to the same group throughout the fiscal year. Those both companies have a financial year ending on the same day. Both companies filed an application for a tax and offsetting tax losses. Those both companies have one shareholder who owns at least 75% of each company. Both companies are registered in Singapore. We also know that in Singapore we have some income received out of Singapore and how it will be taxed. It will be taxable or non-taxable. Should we use the territorial principle, or there are maybe some other points to be used? The foreign profit of a Singapore company is taxed accordingly to Section 10 of Income Tax Act. If a double tax agreement is signed between countries, then you can take advantage of the contractual benefits by applying a reduced withholding tax. Please find that Singapore signed about 50 double tax agreement. If there is no double tax agreement signed, then there is an opportunity to receive benefits within the tax paid in another country in accordance with those income tax acts, provided that income received by a physical person non-resident of Singapore, income received by a physical person resident of Singapore effective from 2004. Tax exemption on foreign income is given if the corporate tax in another country, our main rule, is not less than 50%. And this is in the interest of taxpayers in the following cases. It means about inflow dividends received out of Singapore, income of foreign subsidiary, income from professional services provided out of Singapore. In these cases, we have tax exemption only when using our rule of 50%. Foreign companies and businessmen who are not tax resident of Singapore can transfer money to Singapore without fear that these can be taxed. Complexness can arise if the Singaporean company simultaneously has income inside and outside Singapore. In this case, it's necessary to allocate costs that are considered to be produced in and outside. Now let's discuss withholding tax. So a payer must withhold tax when certain types of payments, such like interest, royalties, services, are made to non-resident companies. So withholding tax is a tax to be paid in the territory of Singapore, but should be paid by a company or non-resident of Singapore. So interest, commissions, fees, and other payments in connection with any loan or independence in the amount of 50% are payable in the amount of 50%. Royalty is payable in the amount 10%. Know-how payments for the right to use scientific, technical, industrial, or commercial knowledge or information should be taxable in the amount of 15%. Management and technical services fees is 17%. Non-resident directors' remuneration or fees in 20%. In the case of double tax agreement signing, a reduced withholding tax rate should be used. These withholding tax rates apply when the income is delivered by the non-resident person through operations carried on outside Singapore. They are to be applied on the gross payment. The resulting tax payable is a final tax. Withholding tax is based on the prevailing corporate tax rate for the year when the services were provided, even if payment to the non-resident is made in a different years. For example, if the service was provided in December 2008, but payment was made in 2009, the prevailing corporate tax is that for 2008 year of assessment, 2009, which is 18%. Revise the sample. The Singaporean company pays interest to foreign company in the amount of 100,000 Singaporean dollars. The withholding tax on interest is 15%. The Singaporean company must transfer 85,000 Singaporean dollars and transfer to the other company. And transfer 15,000 Singaporean dollars to IRS, the amount of 50% withholding tax. So that means that other company, foreign company, is responsible for paying this tax, holding tax in Singapore. but it's paid by Singaporean company who who transfers this amount of interest or royalties or something like that for any services. On this slide, you may find withholding tax rates, all withholding tax rates, all types of payment for non-residents. It's interest, royalties, know-how payment, management, and so on. If to speak about minimizing of taxes and avoiding of taxation, it's better firstly to discuss the main points. Minimization of taxes is a legal way to reduce the tax burden. For example, the application of the territorial principle of taxation. Tax evasion is a crime. For example, including fictitious invoices or non-including invoices for sales, etc. So be aware that there are minimization of taxes and tax evasion. Tax evasion is crime, and we have penalties for tax evasion. Insignificant underreporting of taxes will have the fine in triple amount of the hidden tax or penalty up to 10,000 Singaporean dollars and or imprisonment up to 3 years. So you have the penalty and imprisonment can be combined. Substantial understatement of taxes should be penalized with a fine in 4 times of amount of the hidden tax, with a penalty up to 50,000 Singaporean dollars and or imprisonment up to 5 years. Now let's discuss Goods and Services Tax, GST. So, Goods and Services Tax, or GST, is a board-based consumption tax levied on the import of goods collected by Singapore Customs, as well as nearly all supplies of goods and services in Singapore. In other countries, the GST is known as the value-added tax, or VAT. So in the beginning of our webinar, we discussed and we find the information that the VAT in Cyprus, but GST in Singapore. So the GST rate in Singapore is 7%. The company has to register for GST if the taxable turnover of GST exceeds 1 million Singaporean dollars for the next 12 months. GST reports are submitted on a quarterly basis. The return from the budget occurs within a month after the GST report approval. Once you have registered for GST, you must change GST on your suppliers at the prevailing rate. This GST that is charged and collected is known as output tax. Output tax must be paid to IRAS. The GST that you incur on business purchases and expenses, including import of goods, is known as input tax. If your business satisfies the conditions for claiming input tax, you can claim the input tax on your business purchases and expenses. Types of turnover for GST. Taxable, non-taxable in Singapore. There's such like a financial services. Turnovers outside of Singapore, buying goods in China and selling it to Germany, they are not taxable. The places of services supplied or the location of the supplier, services for export and considered taxable turnover within a rate of 0%. Accounting and payment procedure following the submission of GST report should be on quarterly basis till the end of the month next the reporting one. Fines and penalties as for corporate tax. The last but not the least tax in Singapore is the stamp duty. Stamp duty is a tax on dutiable documents relating to immovable properties in Singapore and stocks and shares. If you do not meet the deadline, you may have to pay a penalty. A penalty of up to 4 times may be imposed on documents that are unstamped, stamped later, or insufficiently stamped. It's an offense to use a document for which stamp duty payment has not been made. In our case, the increase in the share capital is not subject to stamp duty. The rate for stamp duty is 0.2%. The largest amount from the value of net assets or the amount of the authorized capital is taken. A person must pay stamp duty in accordance with the provisions of the document. If in the terms and conditions of the document there is no indication of this, then under the laws of Court of Arms, stamp duty must be paid by the licensor or the acquirer. And for the end, how to use the company in Singapore. You may use a company in Singapore as for international trading, positioning of business in a competitive and economically developed country. You may use it as for international tax planning, because Singapore is in a wide list of countries, FATCA countries, FATF countries, low tax jurisdiction with territorial principle. Advantages of the territorial principle of taxation is the main advantages of Singapore, except financial center in the world. Special purpose vehicles, the holder of the intellectual property right, financing investment for these purposes, a Singaporean company will be good as well. So we will finish our webinar for today, and I'll shortly tell you about our services. Eltoma Corporate Services provide different services in company formation, maintenance, and more than 35 jurisdictions in Singapore as well. The creation and restructuring of the international holding structures, immigration services, opening of corporate bank accounts, maintenance of such bank accounts, legal services. We provide assistance in receiving license and registration of trademarks, tax opinions, taxations in Singapore, Hong Kong, Cyprus, and other jurisdictions. And our new service is property. So, due to the ever-increasing importance of CFC regulations for business-related purposes in Cyprus, we have defined how we can help. We have expanded our services portfolio into property. We have a number of unique properties on the market in Cyprus for investment opportunities. Should you wish to find out more about any of the properties on screen, you can do so by entering our email address in the chat box or on screen, and on one of the property agents will revert to you shortly. Alternatively, you can visit our website eltomaproperty.com. Our offices are in Singapore, Cyprus, Hong Kong, Russia, Ukraine. So please contact us via phone calls or via email info@eltomaglobal.com. Thank you for your time, and we look forward for working with you. Have a great day.